Headlines say the US dollar is falling and blame tariffs for shaking global confidence. But is the dollar really collapsing, or are people just forgetting the bigger picture? We break down the dollar's short term moves versus its long term trends. And at the end, we'll explain why a weaker dollar might actually be part of the plan and what it really means for your wallet.
Gary, you've been talking about it for years, dollar debasement and DKI's positioning to protect against that with positions like Bitcoin and gold, which perfectly segues us into thing number two. Gary, we're seeing investors claiming that the dollar is falling. You're saying, hey, whether or not that's true kind of depends on what point of view you're taking, like most things, and what your time frame also looks like. Gary, thing number two, we're going to get right into it. The dollar is falling, sort of, you're saying.
All right. So, first, Rob, let's make a clear delineation here, because one of the things that we've been talking about on the show for a couple of years now is there are two ways to view the dollar. If you are a foreign exchange trader, you look at DXY, or people call it Dixie, and that is an index of how the dollar trades against other major currencies, such as the euro, the yen, the British pound, things like that. Now, if you are a U.S. citizen and you want to do things like buy groceries, or fill up your car, or buy a car, or pay your rent, what everybody's noticed over the last half decade or so is that prices have gone up a lot. And another way to say that is the purchasing power of the dollar has declined. So right now, we're going to put aside the fact that our dollars are all losing purchasing power, something we've talked about a lot, and actually talk about the dollar as a foreign exchange trader might look at it. So we're going to look at Dixie, DXY. And so there's been a lot of talk in the press lately and on FinX about the plummeting dollar. And so, whether that's true or not really depends on your point of view. The index has fallen, when we were writing this last week, to 99 from its January peak of 110. So, we're talking about a 10% decline over a period of 3 months, and currencies tend to have small percentage moves. So a 10% decline in a few months is significant. But, the question here is at the end of the story.
Yeah, Gary, with all the people claiming that the dollar is, or the people that are claiming that the dollar is down, are they wrong? And then also, I mean, what really is the point of all of this, right? What does it tell you? How are you using this to position yourself in the market?
All right, so let's take those two questions. Those are the right questions, Rob. Let's take them one at a time. The first one is, like, are they wrong? No, they're not wrong, but they're looking really short term. So a 10% decline in 3 months is significant, and people are responding to that. But if you take a look at the written version of the 5 things, we have a chart that goes back 30 years. And when you take a look over a 30-year period, you see something very, very different. So DXY, or Dixie, traded at the 99 level or below that in 2022, 2020, 2019, 2017, 2016, 2015, 2003, as well as many other years. During much of the time between 2003 and 2015, Dixie not only traded well below the 99 level, it traded even below the 75 level. So, if you're looking at a really short-term graph, it looks like the dollar is plummeted. If you look at a long-term graph, this is completely normal. And actually, the dollar is well above its 30-year average. So, these things tend to even out over time. And I think it's really important to take a look, not only just at the short-term view, but the longer-term view. Now, the question you're asking, the second one, Rob, is really, is there a plan for this? Does this matter? How did we end up here? And the truth is, right now, President Trump is very focused on reducing our trade deficit. And we also need to do something about our enormous debt. And so the only way we're going to be able to address that is with a weaker dollar. And the whole point of this is a weaker dollar makes imports more expensive, so less attractive, and exports cheaper for our trading partners. The U.S. products that are being exported to them will to them look cheaper. So, one of the things we've talked about before is that most Americans are not foreign currency traders. and experiencing a weakening dollar each year measured by its declining purchasing power. And we're going to be facing inflation. And that's the only way we're going to get the trade deficit down, and the only way that that we're going to be able to deal with the huge amount of debt that we have. So I think this is going to be uncomfortable, but it is part of the plan.
Yeah, that's great stuff, Gary, there. And I think just in general, right, understanding, okay, what is the perspective that you're looking at something, whatever it might be, right? Whether it's data, specific scenario, life situation that you may be in, whatever it is, right? It all depends. What's the perspective? What period of time, right? Through what lens am I looking at things in regards to the situation or the information? This is this week's version of the 5 things. We're calling it the correlation issue. Be sure to head to deepknowledgeinvesting.com. If you have not already, sign up for a free subscription. You'll be added to our mailing list to ensure that you get every written version of the 5 things, as well as notified when we do post new content to the website. As a free subscriber, there may be content that's gated or paywalled for our premium subscribers who get full access to the entire website, as well as information on current recommendations for the DKI portfolio. And most importantly, when initiating positions and critically exiting positions, more importantly than anything.